Well, good afternoon, everybody, and welcome to the first day of June 2021 and our few moments together known as Bull Sessions. My name is Mark Robertson, and I am joined here by Ken Kabula. Good afternoon, Ken.
Good afternoon, Mark. Glad to be with you this afternoon.
And I think Kim is with us by phone. She's having a weak internet connection, and she's probably just listening in this week. So shout out goes to Kim. She's been very helpful with these programs in the past. All right, I want to launch into this pretty quickly here today because we've got a lot of turf to cover. Much like we did with the Investment Club American Style a few months ago, we'll cover what we can. I think we might get through today, but you never know. What this is basically going to be is a bit of a reprisal of a session that I conducted with Ellis Traub over 10 years ago. And Ken, I assume you've had a chance to kind of scan through some of the stuff and you recall some of the things that we're going to be kicking around?
I did, and some of it overlaps significantly a couple of classes we've done in the last 10 years too, are some of our, especially the disciplined patience kind of stuff. So I'm interested to see where we're going to take it.
Yep. So on that, we'll just say on the heels of Memorial Day, hope everybody had a great Memorial Day weekend. And for those that have family and friends who qualify for Memorial Day, I certainly have some in my family from World War II and even the Vietnam War. Again, it's a moment to remember them and celebrate freedom. Some of the other images there that apply on the backs of tortoises and patience, we'll be talking about that. That's one of my favorite images from my days at Better Investing Magazine. Snoopy and Woodstock is simply a tribute to the reality. And this is probably one of Ken's overarching themes that we're better at this when we do it together. And that's what the campfire is all about. And we'll spend some time talking about that. And then, of course, our favorite magazine cover, at least mine, over the last several years, this was just a reminder that no matter what the conditions are out there facing us, there's always been stocks available to study and buy. If that day ever comes, we'll certainly raise a red flag and say, this time is different, it's really weird. It has not happened yet in many decades of investing. So let's go ahead and roll into this and see where it takes us. Just a quick reminder, we'll have less actual stocks to talk about specifically today. We're going to be talking at a little bit higher level, but when we do, everything that we do here is for education and demonstration. No investment recommendation is intended. Please do your own homework. You will hear opinions from us. Please conduct your own study of a company before making an investment decision. We do try to remember to tell you when we own something we're talking about. We do run a monthly roundtable last Tuesday of every month at 8:30 Eastern Time. If you'd like to be on a reminder list for that, nkavula1@comcast.net is Natalie's email. You will not be inundated. You'll simply be reminded a couple of times a month when we are gathering for that purpose. If you have any follow-up to this session, would like copies of slides, or you have questions or suggestions for future topics, just please send me an email at markr@manifestinvesting.com. Just a quick reminder, this is our standing agenda and our forward-looking queue, known as the bullpen, of future topics. Today we're going to talk about one topic, and that being this philosophy of discipline, strategic long-term investing, and of course the bull continues to celebrate the Memorial Day weekend. All right, Ken, this is the only slide we've got that's outside the presentation. I think it shows pretty well what has happened with the value line arithmetic average. Again, we consider this to be the all of the above graphic for the stock market, because it contains large, medium, and faster or smaller growing smaller companies. It does contain that blend, so all of the above, and it's been on quite simply a tear, as is denoted there by the green arrow, the type of tear or surge or frenzy that can sometimes lead to a flat spot or even a little bit of a dip in the market. The relative strength index of the entire index is approaching 80. Which is a spot which has in the past, again, small sample size, but none of us here should be surprised by either a flat spot plateau or some type of a dip after quite a spectacular run. What are your thoughts, Ken?
Well, I agree with you, Mark. What I'm also kind of happy to see is I know that 5, 6, 7, 8 years ago, we were seriously discussing the fact that had the 10% number, the really long-term average return for stocks, had that begun to decline a little bit away from its really, really long-term number of around 10. And these numbers recently in the last couple of years bring us back so that we're healthy again with that long-term average. And I'm happy that number has stayed consistent, but I don't expect us to move much higher than that number since it's been around for such a long time. And that means that either we hit a plateau for a reasonable period of time, 4, 5, 6 quarters, or we actually see some corrections to what's going on in the market. I certainly hope that we're not going to see anything like we saw in 2008 or like we saw in 2019, early part of 2020. But I am happy to see that the kind of long-term 10% return for the total stock market has repaired itself and it's healthy again.
Yeah, and one thing I do like to do is kind of close one eye and notice that we are basically back on a longer term trend. We're not dramatically above that longer term trend when you look at it with one eye closed, for sure. So again, I think, and this is what we're going to be talking about for the rest of the 45 minutes, is we're back to find better companies and become an owner at better prices, and keep doing that, and don't stop doing that. And I know a lot of people that have basically sat out that green arrow, and it breaks my heart when I see it happen.
We have Kim in the back room with us now, Mark.
Oh, good.
Kim, we just want to welcome you to the back room. You are muted on your end, so if you want to speak to us, you have to unmute on your side. But we're glad to have you with us this afternoon.
She must be overcoming technology down there. All right.
Okay.
Let's go ahead and get underway. This is a quick summary of some of the stuff we'd like to touch on for the next few minutes. We're talking about eight decades of the modern investment club movement and some of the overarching lessons that have been learned. This notion of patient discipline, one of Ken's favorite subjects. The reason we're here to be successful and help others be successful. That's what it really is all about, the discovery of ideas and deploying those ideas. Some reinforcement on the role of quality and how it comes to play. Our method of analyzing a stock is a focus on the business model. We'll briefly visit that from 35,000 feet. We'll get a little more specific with Nicholson's triple play. It bears a little bit less fruit in markets like this, but it's always a good idea. It's a really, really, really good idea during bear markets. We'll talk about that. And just this notion of staying on a path to get better as an investor. Any thoughts, Ken?
Nope, I like what you're saying, Mark. Let's get to it.
All right. Let's talk about this philosophy of patient discipline. And I will tell you flat out that the book that you see on your screen, they used to give out at the National Association of Investors back in the early 1990s, probably changed my life in a dramatic way as an investor, and in some of the stuff I became involved with as a volunteer, and ultimately on the Better Investing magazine staff. And I believe that the foundational principles in that book are the heart and the foundation of manifest investing. Manifest investing is an attempt to take the lessons delivered by Nicholson in this grand experiment and this methodology and put them at your fingertips. How to discover ideas, how to deploy those ideas. And those are pretty bold words. I just love that last paragraph. I think it's still true today. Simple is better. Complexity, when you hang more bells and whistles and start doing second derivative analysis of companies, you're probably spinning your wheels. And every time I go into anything that's algebra or calculus related, Ken always throws a bucket of water on me and calms me down. Your thoughts, Ken?
I'm trying to do 15 things at once right now, Mark. I'm on the phone with Kim. She is having some internet issues, so I'm back and forth with Kim.
Okay.
But I do strongly believe that you can do yourself a little bit of disservice as an investor if you try to sink too much into the mathematics behind any of the tools or the things that we talk about. There's as much art to investing and to sizing up a company as there is mathematics behind it. And I think that absorbing and patiently understanding that message is very important in becoming a success.
Absolutely. And then we'd just love to point out that those words in that last paragraph are pretty bold, stacked up against mountains of investment books and magazines, and you can pile in all of the talking head videos from the television over the last 20 years. And it really does come down to this dramatically simple notion of sticking with what really matters. And Nicholson taught us that you really only have to care about a few very key components of any investment analysis. And we think that when he wrote that book, he'd been at this for about 50 years. And so it represents basically the notes expressed by a very successful investor describing 5 decades of working with individual investors and investment clubs like all of us. If you see a name on that list that you don't recognize, like perhaps a Walter Schloss or an Arnold Bernard, I would encourage you to do a quick internet search, Google or DuckDuckGo or whatever works for you, and spend a little time with those guys, because the names that you see on that screen are all pretty consistent with what we do in the modern investment club movement, and they've all participated in some way or influenced in some way. We just encourage you to take a closer look.
I'm going to ask Kim, Mark, whether she can hear us and whether she can speak to us, and if she has any reaction to this slide.
Okay.
Yeah, I can hear you perfectly. Timing's everything, and I just got the internet back up.
Okay.
Terrific. Okay.
Yeah, and I want to tell everyone in the audience, whenever you're bored, go to eBay and take a wild chance. I went to eBay one time, and I'd been there 50 times beforehand, and I found this very book on there that somebody was selling. So even though they may be out of print, occasionally you'll get someone who will put it up for sale on eBay, and I think I got it for like $8 or something. It wasn't very much.
Yeah, it's a great point, Kim. I've actually ordered them on Amazon before, and then there's a couple other secondhand bookstores that have had them from time to time. I will issue the warning that if 5 of you go out and place orders, the stock price will, or the book price will respond dramatically to that.
Well, and then the other thing is, I've got to see if I can find my notes. I had a place that we had talked about booksellers that sometimes they have the books by PDF, and I don't know if they would have that there.
Pretty sure they don't have this one, but that's a good point that some of them will for sure. Okay.
If I find it, I'll send it off to you.
Okay, thank you, Kim. All right, let's go ahead and talk a little bit about this one then. At Manifest Investing, we basically boil down these 8 decades of lessons into the 2 most important characteristics of any investment: expected return, that's the return forecast, and the quality. And patience is so important when it comes to investing. And Ken, what are your thoughts on the subject of patience?
Well, you understand my thoughts, Mark, that patience, and along with the patience comes discipline. You have to understand what your particular rules are going to be, and then you have to patiently follow those rules, have the discipline to remind yourself continuously what the rules are, and then sit back and wait for the whole process to work. And it will work for you if you have the patience and if you have the discipline. And I'm not talking that it's going to take 3 or 4 years for it to work. It will begin to work for you in a relatively short amount of time. I've started a number of different investment clubs, for example, and the opening remarks always include something along the lines of, let's try to be patient for the first year and a half, learn our discipline, learn what we're going to do, learn what makes this whole thing stay coherent and stay in a position where it'll help us make money. And then let's sit back and watch our numbers, our return numbers start to build. We might make some really great mistakes in the first 18 months or even 2 years, but if you'll give it the patience, if you'll give it a little bit of time, then it will reward you. And then all you need to do is kind of stick with the process. Don't get real fancy. Don't go searching for all kinds of added extra things you can add to the process. Keep it straightforward, keep it simple, and make sure you understand anything new before you add it to whatever it is that you're doing in the first place. Be patient. I don't think he could have chosen any better word than that to describe the foundation of better investing philosophy.
And I have to agree with you, Ken, because I've read this so many times that Buffett and Munger will say the worst characteristic that an individual can have is being impatient, because the best investors know how to sit on their hands and do nothing. Follow your stock, yes, but you got to give it an opportunity to do what you're expecting it to do.
Yeah, and I will also chime in with, you can actually look at the holdings of the round table tracking portfolio, and you can go back and look at some interesting investments, fairly obscure investments chosen by people like Cy Lynch. And we'd come back, a year later and say, this hasn't done much yet. And Cy's response would be patience. It's a work in progress. They're still firing on all cylinders. And then the next thing you know, you do get one of those surges like we were just talking about for Charles Schwab. It really is it can be a very difficult thing to do, to sit and watch your company. A lot of times the price will go stagnant, but the operations behind it, behind the fundamentals, continue to chug along, and that's what we keep track of. So buy and hold.
And I'll never.
I think one of the hardest things to do. Go on, Kim.
When you're done, Ken.
I think one of the hardest things to do when you're a leader in an investment club is to put up with a 35 or 40-minute meeting. Your instincts say that in order for this stuff to be successful, you should be spending time. And when you have a meeting that only has enough business to fill 35 minutes, sometimes you feel a little bit guilty. I say take the time and run with it. You can always find other things to occupy your time. And if you've accomplished all you needed to accomplish, then your patience takes over, and maybe the next meeting will be an hour and 10 minutes, and maybe the one after that will be 2 hours. But you don't have to fill every meeting to some predetermined number, time, whatever it happens to be.
So it's not like church.
It's not like church. That's right, Mark. Sometimes I can remember sitting in the pew. My dad was a deacon in the Presbyterian church in Cleveland where we went, and I can remember sitting in the pew because we were always down front. And I would say to the minister, in my mind at least, okay, your point was made and you did a really good job at it. Now we have an extra 10 minutes. Let's get out of here. It never worked, but I can remember saying it.
Kim, you got another thought? Or?
Well, the biggest thing I've learned, I'll tell you, a mistake of mine. We were all when 08, 09 happened and the market went down with everything. And actually, it was after the Twin Towers in New York. I bought Johnson & Johnson. I waited 7 years, and I guess that was bad luck because I sat on my hands for 7 years. I sold it, and it was like all it had to do was not have me owning it. And 6 months later, it had gone up $50.
Yeah.
I just wasn't patient enough. It was doing exactly what it was supposed to do, and I wasn't patient enough.
Yeah, the woods are full of those kind of stories. And speaking of church, Ken, I've been out with you on a number of Saturday morning or evening encounters with investment clubs, and I love when you lead off with this question.
Why are you here? Is
Yeah,
that
why are we?
I have my screen covered up with the question box right now, so I don't see what slide we're on, but I can guess what the question is because I use it 90% of the time when I visit clubs as my lead. Yeah.
Yeah, and it really comes down to this. And of course, we've got Gordon Gecko there on the screen. Greed can be good. And Ken and I both have friends who have been amazing philanthropists. And that's why we're here, to basically access freedom and share it. All right.
We're getting two of our longtime participants in our audience making some good comments as well. Mark Ann Manning from down in Texas there says that having a manifest investing dashboard has also helped her. She'd like to give credit where credit is due. It's also helped her to become much more patient. She can really see if the stock is ready to sell. She can really see if she's being too, a little bit too rushed in order to get rid of it, or if she hasn't really moved quickly enough to make that happen.
Mm-hmm.
Matt Spielman says that his favorite Buffett quote is, and Matt's another Texas, a transplanted Texan, but a Texan nevertheless. Matt says he likes it when Buffett talks about the stock market being a no-called pitch game, which means you can stand there in the batter's box and you don't have to swing at anything until it's perfect. The only thing you have to do is resist all the people around you yelling, "Swing, you bum," when you can't find anything good to swing at.
Very true. Well, here we just want to reinforce that we believe that the result of any stock study is the bottom line result that you get in Section 5 of an NAIC stock selection guide. It's the return forecast. What do you expect from the company? Our preference is for those projected average conditions, or it's known as PAR, projected annual return. And so you're really only talking about the current price, which is always an obvious given, and then a future price, which is based on what you imagine the company will do for the next 5 years, and adding in the dividend yield. So that time horizon is always 5 years. For any study that we do, we're always trying to look 5 years out. And again, this math is actually, it can be a little bit challenging the first few times around the block, but eventually it becomes pretty simple. You build a earnings forecast based on your study of the company, its growth and its profitability, and then you take a stab at a PE ratio which is viable and feasible, and you end up with this type of a forecast. And really, that is the bottom line of any stock study. It's one of the two primary characteristics of any investment, in our opinion, and again, a real cornerstone for what we do. All right. Well, speaking of Buffett, you guys have all kind of set the table for this. We used to joke about Warren be sitting there with his feet up on the desk, and we finally found a picture with his feet up. Well, I finally found one, Ken. That's his desk in Omaha, and his feet are on the desk. And it does come down to this notion of understanding your company and imagining what it might look like 5 years out. And any stock study really should include this assessment of where do they seem to be headed. What does the sales trend look like? How are they going to get there? What things might get in the way, or what things might enable that to happen? And it really does come down to this notion of a vision, or imagining what that company may look like in 5 years. Your thoughts, Ken?
Well, I think the most important thing you said there, Mark, was that Buffett is thinking about how are they going to get to where they need to be in the next 5 years. And that doesn't necessarily resolve itself by saying they're going to continue to do what they have always done. great companies, I think, are continually reinventing pieces of what they do, changing their product mix, keeping their products or their services at the cutting edge, or even a little bit out beyond the cutting edge. And that's how I think that the managers continue to turn an EPS value that is consistent and that you can rely on year over year over year. I think that's one thing that a lot of times we forget to do, and that's to model what we think will be the growth drivers for the company in the next 5 to 10 years. Not what has been the growth drivers, what is the historical story.
Mm-hmm.
While that's important, I think we have to look forward and ask ourselves, how much of what they were doing are they going to be able to continue to do? And when they're going to drop things, what will they replace it with?
And Kim, I'm wondering if you've made at least 20 trips to Omaha. Have you ever been to Warren's office?
Not quite 20, but I am working on it. But no, I have not. I can't say I have. I have read lots and lots of books on Mr. Buffett, and every time I read something, I learn something. So anytime any of you in the audience would come across a book, it's amazing what you find out there. And I have to admit that YouTube is a wealth of information. When, you know, you want to watch something, there are some great lectures on there, especially with all those names that Walter Slosh and Maynard Keyes and Roger Lowenstein, who writes about Buffett, and some things with Charlie Munger. That's pure joy for me when I see those things.
Yeah, and one thing I noticed here's a little hint about a future investment up on the top of his bookshelf there. That's not the railroad he bought. Could have been the inspiration.
Dennis was challenging you, Mark, to find a computer in that picture anywhere.
Yep, you won't find it. Buffett always says he is a computer. He's right. You know, you keep the math simple enough, anybody can do it. I mean that. I mean, it's that simple. So anyhow, the rule of quality.
It's the key to teaching, Mark.
What's that?
It's the key to good teaching, especially if you're trying to teach physical science or mathematics. You have to keep it simple enough so that people can imagine it. Now, some of that flies out the door when you move into quantum physics and you move into 8th or 9th semester theoretical calculus. But in the beginning, at least, it has to be kept simple so that people can imagine what you're talking about and put it into plain terms and come to grips with it.
Mm-hmm. All right, let's spend just a few minutes talking about quality and why we care so much. Again, it's the second most important characteristic, or one of the two important characteristics of any investment. There's the definition. I don't quibble with the definition, but I do love the investorwords.com definition, the measure of excellence. We do score quality at Manifest Investing. It is based on the work of George Nicholson and Benjamin Graham, and their definitions match exactly, point by point, maybe even a little bit of research and cooperative effort there, or certainly follow-on effort, but they do the same assessment of quality that we do. And here's just a quick reminder as to what those are at Manifest. Again, keep in mind that as Graham was struggling with the heels of the roaring 20s and the stock market that collapsed at the end of the 1920s, and at the same time Arnold Bernard founded the Value Line Investment Survey, because his mom had been absolutely ravaged by Wall Street at the end of the 1920s, and both of these gentlemen regarded it as a little bit of a gun-slinging fight at the OK Corral when it came to investing, and it just simply had to be brought to something that made a little more sense. And that's what all of these efforts were about, the book Security Analysis and the Value Line Investment Survey. And as you wind your way through it and basically study the work, you find this notion of a coefficient of quality, and it is the linkage to the PE ratio. It's kind of a fascinating linkage. It includes emotion and respect, but this coefficient of quality that Graham talks about in 1934 is known today as a PE ratio. And I just love Jeremy Grantham's. That's the response to me during an interview out at the Morningstar Investment Conference. And his definition of quality is also strong, dependability, return on capital, all that kind of stuff. And there are the 4 components down at the bottom of the page that we basically score and rank at Manifest Investing. Your thoughts, Ken?
Mark, am I right in saying, Mark, that if you read the original Benjamin Graham book carefully, that he also had a nod to dividends in his quality definitions?
He did. One of the reasons we left it out is they were talking, during well, first of all, let me back up. Dividends are basically a function of earnings, and the stability of dividends are basically a function of the stability of earnings. So it becomes almost redundant if you really put it in those terms. The other thing to realize is back in those days, the average dividend yield on a stock might be 6 or 8%. And that's a stark difference from today. The average dividend yield is about 1%. So that has changed. It's one of the few things that we can say actually has changed. So yeah, there was a fifth thing on here, but again, I would blame redundancy for the reason that we've left it out. It's contained in a couple of those other pieces anyhow. Dividends would be, and it's obviously in the return calculation.
Yeah, it's not any criticism, but I know that when you go back to some of the original stuff, you get this leaning on dividends a lot more than you see in modern writings, and I think that you already gave the best reason why folks were leaning on dividends in the 30s and 40s, because they constituted a much more important part of the return than they do today.
Yeah, and in fact, we don't need to spend time on it now, but the dividend discount model was basically the reality that the dividend actually determined the stock price. And again, we don't need to go into it now, but because of the prevalence and relevance of dividends, that was true back then.
Well, we still have a little bit of it left on our stock selection guide in one of the low price choices. The price the dividend will support. And I think that's what you're referring to, isn't it?
Yep. All right, here's 2 quick slides. Many of you have seen these many times, but it's just a powerful reminder that we shop amongst the excellent companies that have the highest quality representations to us, or good. I mean, we sometimes will dabble in the others, but the reason that we do this is really simple. Nicholson told us it'll keep us out of trouble. It's kind of a form of an insurance policy, if you want to think of it that way. What you're looking at on your screen is we took the 20 lowest quality companies back during that crash in 2008, 2009, and noticed that the average company went down 60% per year over that 2-year time frame. And I believe there's at least 2, if not 4 companies that actually disappeared from the planet back during that time frame in this group. So again, the lower quality companies behave like that. And again, just ramming through this real quickly, in stark deference to that previous slide, here are the 20 highest quality companies back in the same time frame. Some of them actually managed during the worst bear market in stock market history to generate positive returns. And you'll see Cognizant, Coach, Gentex, you know the names, O'Reilly, Fastenal. What am I leaving off, Ken?
Well, a couple of ones that I still think are good old reliables. Pepsi comes to mind immediately, as does Colgate.
Yep, Colgate, one of the favorite stocks in our family. So again, the difference, there were losses here, but they basically buffered one of the worst bear markets in history. And time again, we've seen these type of companies, because of flight to quality, actually lead out of the really nasty periods. So why did Nicholson care about quality so much? Why did he talk about it so much? For that reason, that you want to find leaders, the better companies at better prices. So that's what Graham's talking about when he talks about a superior comparative record a better comparison. Find the leaders and own them when it makes sense to do so. And that's the role of quality in our portfolios. Okay.
Very, very important to have the quality in the leaders. I'm going to have to think of one of the books that our book club read emphasized the exact same thing, and I'm going to have to go back and figure out which book it was and let you know, because it even talks in there that those better quality stocks are at the top of that market sector. And a lot of times they are a monopoly, or just, there's only 2 or 3 of the leaders in that area. And those are the stocks that will always do the best. So that quality is paramount of importance. And even the top stocks with quality, they have a pullback. So you can always put an alert on it and say, it drops 10%, 20%, let me know. And then you don't have to go looking at your computer every single day. You just might have an email sent to you saying, oh, look at that, your alert's hit.
Yep. All right, let's talk a little bit about the analysis that we do with this focus on the business model. Again, the Dilbert cartoon there is just for a little bit of levity, but many of us have been in that situation where management says, go get out there and do this, without a whole lot of guidance as to how we're going to make that happen. And as Ken was saying earlier, I think that a study of a company really should include this series of questions. And that's one of the more important aspects, especially when investing as a group, known as an investment club. How do you, frame some of these questions and the answers that erupt as the group debates and discusses an opportunity. All right, shall we move on?
You've never worked for any visionaries like this, though, Mark. I don't think, have you?
I'll plead the.
He's
I'll
such
plead
a
the
visionary, Ken. He has to work independently,
Okay.
like the rest of us.
I'll plead the fifth on that one.
Okay.
We all 3 will.
Okay, times 3. Okay, and then again, most of the audience knows that this is the way we look at companies, and this happens to be an example of Walgreen from mid-2009 and how it ended up 5 years later. Again, we take a look at the current condition of the company with the current income statement here on the left-hand side, the core characteristics of the company, and then we make assumptions about how they will grow. That's the 8%, becoming a 90 billion company 5 years down the road. What their profitability will be. At this time, we were thinking that they might actually improve their profitability a little bit, and what PE ratio might be involved, 5 years down the road, and come up with an assessment of a company which was projected to have a return forecast of roughly 14%. Now, I etched in these numbers in pencil. It actually only grew at 5%. This is before the Boots Alliance merger, so it's right before that happened. The profitability came in okay, but what was kind of interesting is there was a little bit more expansion when it came to PE that more than offset the drop in sales, and we actually ended up with about a 20% return. But those numbers are all pretty consistent and pretty normal variations in a study that we do. So again, these are the major aspects of the business model that we try to understand for any company that we study. Anything you'd like to add to that, Ken?
Well, Mark, I need to grab the upper right-hand corner of this thing and slap it on a few slides in presentations that I make. It more than shows the power of PE expansion in this whole equation. It focuses on the fact that if the market is going to treat you as a star, then you're going to make more money for the person that owns the stock in whatever it is. So I'm flabbergasted by the fact that the sales are down. On an 8%, they're down 3 points out of 8, and yet the actual total return is up 50%. That's eye-opening.
Yeah, and actually that contribution can come from any one of those three elements. We're going to talk about the triple play in a minute, but it's important to realize that those are the three aspects in a business model centered analysis that matter so greatly. All right, let's go ahead and move on. Again, just a kind of a summary slide here that this is as simple as it really can get, guys. We're talking about understanding the company, and what they're trying to do, and understand that top line sales forecast. Tom O'Hara used to talk about the sales trend and the expectations for sales in the future being the straw that stirs the drink. And he's just basically saying you really want to sink your teeth into that and understanding. Some examples there of changes in growth rates could be the end of geographic expansion for a retailer or expiring patents on a blockbuster drug. All of those things need to be taken into consideration. And in fact, we had a case study back in the late 1990s of Toys R Us, which dramatically had a change in legacy. The parent actually died, and the family that took over didn't do quite so well, but they also reached saturation when it came to the number of stores out there. Second, the profitability, something that Nicholson spent a lot of time talking about. And we're not yet talking about PE ratio. We're talking about the profitability, the percent margin, or as it says, their percent of sales. You really want to understand especially how that compares versus their field of competitors or peers. And spend some time understanding, how much better are they? Why is that the case? How likely are they to stay there? And last but not least, that third element, as was shown on the previous slide, the PE ratio. Understand that there are a lot of things that affect the PE ratio. And two conditions that are not listed on there are just simply respect and emotion, or sentiment you could think of. That is where sentiment and respect and emotion come to play in the analysis of any company. All right, should we press on?
Well, the only thing I want to say, Mark, is that we might be on the cusp of adding an asterisk to number 3, which is the whole noise that we've done about PROVE, the potential return on equity, and how it can help us determine whether PE expansion or PE contraction, for that matter, is real, or if it's maybe just tentative and there's another shoe left to fall yet. I'm more and more excited by that whole concept as I see it working out time and time again as a cautionary signal to tell me to be a little bit more mindful of the PEs that I'm trying to choose going forward.
Yep, that's certainly a subject that we'll tackle in much greater detail in future sessions. We've covered it a number of times, and I'll put some links into the show notes if people want to dig in and catch up with some of what we're talking about there. We're basically talking about building an imagination of what the company may be in the future without using the PE ratio, at least not up front, or using this projected return on value to condition or adjust a PE ratio in the study of a company you either are thinking about owning or already own. All right, let's talk about the triple play a little bit. This is again an area of application that people have found to be dramatically rewarding. And Ken, why don't you take it away? I know it's one of your favorite things to play with.
Well, what's interesting, first of all, Mark, is that this is kind of a throwaway in the book that we've been talking about. That book that you featured back, a dozen slides or so. You'll find this whole concept kind of as a filler at the bottom of one of the pages.
Mm-hmm.
It doesn't really fit where it's stuck, but it's there and it's complete. The idea is complete. And basically, Nicholson was saying, there are 3 things you really need to look at to identify a stock that might be in a breakout period. And these 3 things become better signals at the end of a bear market than they might be in the middle of a bull market, or even at the beginning or end of a bull market. So while it's not as valuable, or the wrong word, while it's not as predictable, the predictability of the triple play isn't as high at this particular time in a market like we're experiencing. We certainly have not seen the end of bear markets by any means, and I think we're likely to see one in the next 5 or 6 years. It might be sooner, it might be later, and that's as much as I can do for predicting when it will happen.
But it will start on a Tuesday afternoon.
Tuesday afternoon, okay. He says, look at the price of the stock. Is it depressed? And if it is depressed from, quote, normal, unquote, levels, and that's as much in your mind to determine as it is to determine mathematically, but if the price of the stock appears to be depressed, that's number one, because then it has more room to rebound back to more normal levels. Number two, the second piece of the triple play is that profit margins have a really good chance of rebounding from where they are right now, or growing from where they are right now. They might be depressed and then they would rebound, or they might be normal, quote unquote, but they might have some growth potential because of whatever the company is going to be doing in the future to grow the company. So you look for growth in profit margins. And finally, if those two things are in place, then you look for the possibility of PE expansion. And Mark just showed you a slide to indicate how dramatic PE expansion can be in total return when you're looking at expanding the PE even a few points. I think that we expanded that PE on Walgreens, 3 points out of 18?
Mm-hmm.
That's still a pretty good upward movement. You find all three of these things happening, and that doesn't mean you found a great stock to buy, but it means that you found a great stock to put on a list of stocks to study. And if it is a triple play, then move it to the top of your list of stocks to study, because the chances are, says Nicholson, that this stock will do more for you than a stock that doesn't exhibit these three characteristics. I think that it's great advice. You're not searching for stocks to buy, you're searching for stocks to study. And when you find triple play candidates, move them to the top of the list and study them first. You're not going to be losing anything by studying a better candidate first over the top of a less desirable candidate. So do it and see where it leads you. I think the other thing that you put in conjunction with this, Mark, is that we're really looking for high quality stocks when we're dealing with this triple play as well.
Yes.
We don't want to apply it to lower quality stocks, especially stocks that might sit at quality levels of, I don't know, 60, 65 or less. We definitely want to apply it to higher quality stocks because Nicholson had other words for investing in low quality during any market. He thinks it's a really bad idea and can result in really terrible returns.
In fact, I'm going to share a list of a few companies and we can dig into that a little bit deeper. But right now, I'd like to put Kim on the spot. For those of you that aren't familiar, at these roundtables, we do it once a month. We all present stocks, and then the audience, we do a poll of the audience, and they select from the 3 or 4 stocks that are presented during the evening. And Kim's stocks are often chosen by the audience. And Kim, I'm going to put you on the spot here. It's the fault of the triple play presentations that you do, right? Is that how you're stacking the deck here? Do we still have Kim?
I haven't checked. No, we don't. We've lost Kim, Mark.
Okay, well, now she's not here to defend herself, so now I feel really bad. But the point that I want to make, though, she often will lay out an idea in terms of this triple play, and it makes so much profound sense that I think the audience is heavily influenced by it. There's nothing wrong with that. It's worked out. Again, here's an example that Nicholson talked about on the pages of Better Investing magazine back in September 1974. You may remember you used to buy gas by your license plate and the day of the week and that kind of stuff back in that time frame, just to put a date stamp on it. And Coca-Cola was featured on the pages of Better Investing magazine. And then he came back just a few months later and warned investment clubs about how when you find one of these and the situation really looks good and the situation is right, don't sit on your hands for too long in this type of a situation, because Coca-Cola gained 80% over the next 6 to 8 months, while the stock market did do some recovery. But notice that 80%, you can barely make it out there on the left. But it's just an example of the type of thing that can happen when you find one of these. We've actually experienced this with some of our regional investing conferences around here, where we'll present the companies to dramatic positive results, especially coming out of a bear market. And so, Ken, what I did for today is I just put together a quick list of triple play qualifiers that also have an upside downside of greater than 4. And that is a teaser. We're going to come back and show you how the upside downside ratio greater than 4 is exactly what Hugh McManus looks for with his Irish spring screen. That's for a future bull session. That's a teaser. Come back and watch the math on that one. But here's a pretty good list of companies, and there's a pretty wide berth of companies here I am intrigued by. In fact, I'm going to have to run a study on Clorox. It just keeps showing up. There's Clorox, and here's Proto Labs, Strategic Education. What jumps off the list at you, Ken?
Well, Proto Labs jumps right off because I owned Proto Labs. I brought it to the round table 4 or 5 years ago. I owned it myself for 3 or 4 years. I thought it became quite overvalued. And to be honest, I'm a little bit surprised to see it appearing back on screens like this again. It has not yet begun to appear on some of the things that I do. But I'm always been a fan of what this company does. There's my old favorite Merck on this list as well. I don't know. Every time you throw a list up, Mark, no matter what it's made up of, Merck seems to sneak onto the list. At some point, I think people should start to take a serious look at why Merck is sneaking on so many of these lists that are possible great ideas, and maybe take a go at the company. And right below it, there's Ali again. Yep. You know, Ali just seems to move everywhere that these interesting companies are residing, and it seems to be on the list as well constantly.
Yeah, and one of the reasons I shared this is I think we're within weeks, if not days, of providing a checkbox on our search, which will basically be a checkbox, show me the triple play companies on our stock screen at Manifest Investing. And we're going to also work to include relative strength index. That might be the answer to Ken's first point there about the stock price being depressed and capable of recovering. Anytime a RSI is below 30, you see some right here, there's a lot to like on this list of companies. Anytime it's below 30, it could be oversold, you know, presenting an undervalued opportunity to us. So any of these below 30 might be worth just a quick look, you know, and maybe dig in a little bit deeper. That projected return on value that Ken was talking about, I am more and more swayed by this number all the time. I love it when they are double digits. Right now, the average projected return on value is about 6%. So anything above 6% is good. And double digits even better. So anytime a company has decent numbers there, this one certainly needs an audit. There could be a bogey in there somewhere. But
yeah, I'm just, I can't remember seeing a proof number that high. What is PRDO, Mark?
That's one of those education services companies. So
okay.
I can't even pronounce it. It's one of those, and so it's that type of thing. But again, these are screening results. They're a starting point, not a finishing point. So one of the other things I wanted to mention on this slide: anytime you see this, all it should do is be a nudge to you or a reminder to you that all that means is that the current stock price is probably really close to the 52-week low, or the low week you've chosen if you're using a stocks, or the low price you've chosen if you are using a stock selection guide approach. In this case, we're comparing them versus the 52-week lows. So that it's just saying these companies are fairly close to the 52-week lows. And we'll cover that in more detail here in a few weeks when we talk about the Irish Spring inverted. All right. Any other comments on that, Ken?
Nope. I have these slides, so we're developing a stocks to watch list at the Wolves again right now, and it looks like I have a couple of candidates to add to my yes/no list to start with here.
Well, I think Merck might be the first stock, well, not first, second or third stock I ever bought back in the 1990s. So it's calling to me.
I probably haven't owned Merck for, I'm going to guess, 25 years now, maybe longer. I did own it as an early investor, but I haven't for a long time. But I just can't get over the fact that it just keeps popping up everywhere right now.
Well, I discontinued owning it when they had that other company they merged with, and then they blamed everything on the other company, and it's a story for another day. Anyhow, just a reminder, again, talking about the works of Nicholson and the efforts of O'Hara and Janke and crew and all of that kind of stuff. I mean, I have been there. I have witnessed this. $20 a month since 1948 becoming $1 million balance. In fact, it was $1.5 million at the time that I joined the Mutual Club of Detroit back in the mid-1990s. And so Tom O'Hara's investment account actually outperformed by a couple percentage points over the long term. And it was just marvelous to sit there and watch, because I knew that he had only invested a grand total of $16,000 since February 1948 into this account, and his investment club balance was like $1.5 million. So it can be done. I've watched it. I've seen it up close and personal, and it's just a wonderful thing. So yeah, Memorial Day, it's kind of fitting that this fits here. And again, just closing out with some of the main thoughts we've talked about, some of the main things that we believe. He did encourage people to continue to grow. You know, after you get your feet on the ground, continue to grow and challenge your club partners to grow. Get out there. Don't be afraid to attempt to understand non-core investing, early stage investing. Hugh McManus and Kim Butcher are two of the best at this in our roundtable cast of characters. And I dabble with it, but he was just knocked the doors off over the years. Buy and hold is not a strategy, but the words after the ... are huge. Buy and hold for as long as it makes sense to do so. Do it with discipline, do it with patience, and just a few other things that make sense to us. And again, we do think that we get better at this when we do it together. You know, in a word or a phrase, investing with your friends. Your thoughts, Ken?
Well, and you get better at this when you find one or two folks that you trust, that you can talk it through with as well. I can't tell you how many times, Mark, that an idea that I've had half formed in my mind has come all the way to fruition after spending an hour or so running it back and forth between the two of us, trying to figure out exactly why I believed what I was believing. I think that it's so important that not only that you sit at investment club meetings, but you get involved sometimes in the discussions, and you ask the questions that are bothering you, keeping in mind that if the question's bothering you, it has to be bothering at least one other person in the room. And the question's going to be welcomed. So don't be afraid to ask it. That's the other side to an investment club. It's not just pooling your money and saving time, but it's also having the ability to get a lot of viewpoints and to get them out in the open, and to shed light on the different ways people are thinking about investing and about particular investments.
Good stuff. And so I'll just close by saying that the linkage between Memorial and Independence Day has rarely been stronger. That's just simply a notion that, doing this well and achieving and realizing success can be a powerful thing in our lives. And that's one of the things that we do believe. So with that, just a quick reminder that we do archive all of these sessions on YouTube. You just search for Manifest Investing. This happens to be a collection or a picture of the 5 sessions for each of the 3 successful investing conferences. We nicknamed them COVID cancellation 1, 2, and 3. We hope we don't have another COVID cancellation conference, and that these are the only 3 that we have, and that someday in the not too distant future we are doing this together face to face. And with that, we'll leave with that image from a movie. You guys can all identify the movie in your comments. I think it captures the spirit of the season that we're in. I sat in a park very much like that one in Rochester, Michigan yesterday afternoon with my 1-year-old grandson in that same position with a very, very similar view. So with that, we will wish you all a continued good summer, and we'll hang around for a few questions if you've got the time to spare, Ken.
I do, and we don't have a lot of questions